A letter, one page, supposedly from Bank of America, confirming that Parmalat held $4.9 billion in a Cayman Islands account. Auditors received it. Regulators accepted it. Investors built their entire confidence on it. The letter was a forgery. The account did not exist. The money had never been there. Parmalat was, at that moment, the 8th largest company in Italy, a global food giant selling milk and dairy products in over 30 countries, with a market capitalization in the billions. And it was hollow. Completely hollow. Callisto Tanzi founded Parmalat in 1961 in Collecchio, a small town in the Parma region of northern Italy. He was 18 years old. He had dropped out of university. What he had was a pasteurization license, a modest family business, and an instinct for scale that would, over the following 4 decades, build one of the most recognizable food brands on earth. The product was simple. UHT, milk, ultra-high temperature processed dairy that could sit on a shelf for months without refrigeration. In the 1960s and 1970s, this was a genuine revolution for Italian households. He moved fast. He invested in processing infrastructure. He locked up distribution. By the late 1970s, Parmalat was the dominant force in Italian long-life dairy. Then he went further. Through the 1980s and into the 1990s, Tanzi pursued an aggressive international acquisition strategy. Brazil, Argentina, Australia, Canada, the United States. Parmalat bought dairy businesses, juice brands, bakeries and football clubs, including Parma AC, which under Parmalat's sponsorship became one of the most successful clubs in Italian football. The story was compelling. A provincial Italian entrepreneur building a global empire from a single carton of milk. In 1990, Parmalat listed on the Milan stock exchange. The IPO gave Tanzi access to public capital markets and, crucially, to a new class of investor who would come to trust the company's published accounts. The listing valued the business at a level that seemed, on the surface, to be supported by its global revenues. Analysts wrote favorably about its diversification. Credit rating agencies assigned investment-grade ratings. Banks extended credit lines. But underneath the revenues, underneath the acquisitions, underneath the football glamour, a structural problem had been building since the early 1990s. Many of the overseas acquisitions were underperforming. Some were losing money outright. The Brazilian operations, which were supposed to anchor Parmalat's Latin American growth story, were generating far less cash than the company reported. Rather than disclose the losses, Tanzi and a small group of senior executives, according to findings by Italian prosecutors and the SEC civil complaint filed in December 2003, began to construct a parallel financial reality. Losses were hidden. Fictitious revenues were recorded, and the network of offshore entities, many of them registered in the Cayman Islands, was used to move liabilities off the main balance sheet. The centerpiece of this structure was a subsidiary called Parmalat Financing Corporation, incorporated in the Cayman Islands. Parmalat existed, on paper, to hold assets on behalf of the Parmalat Group. In practice, according to the SEC complaint, it existed to absorb losses and to fabricate the appearance of liquidity that the group did not possess. The $4.9 billion Bank of America balance. The forged letter. For years this held. The auditors rotated. The offshore structures were complex enough to obscure. And Parmalat kept paying dividends, kept issuing bonds, and kept telling the world it was growing. By 2003, Parmalat had accumulated approximately 14 billion euros in debt, a figure so far in excess of what the company's operations could service that, in retrospect, it seems almost impossible that it remained hidden as long as it did. But debt, in a sufficiently complex corporate structure, can be made to look like leverage rather than crisis. And Parmalat's structure was extraordinarily complex. The group comprised over 200 subsidiaries spread across 30 countries. Intercompany loans flowed between entities in ways that were difficult to trace, even for sophisticated analysts. The offshore vehicles in the Cayman Islands, Luxembourg, and other jurisdictions served as both a financing mechanism and a concealment layer. When one entity needed to show a cash balance, another entity would record a corresponding receivable. The books balanced, on paper, because both sides of the fiction were controlled by the same small group of people. Grant Thornton had audited the Parmalat subsidiary. Deloitte had audited the Parmalat parent. Neither firm, according to subsequent regulatory findings, had obtained direct confirmation from Bank of America of the account balance that underpinned Parmalat's reported assets. Here is what no one outside the inner circle had yet understood. The entire liquidity position of the Parmalat Group rested on a single document that had been fabricated using a scanner, a computer, and a letterhead that had been copied from a genuine Bank of America communication. The forgery, when examined closely, was not sophisticated. The font spacing was inconsistent. The account number reference did not correspond to any account held at the bank. But no one had looked closely. No one had picked up the phone and asked the right question at the right time. That changed in late 2003. Grant Thornton, under pressure from Italian market regulator Consob to provide direct third-party verification of Parmalat's assets, sent a confirmation request directly to Bank of America. The bank's response was unambiguous. The account did not exist. The balance of $4.9 billion had no basis in any record held by the institution. The confirmation landed in early December 2003. Within days, Consob had been notified. Italian prosecutors opened a criminal investigation. And Parmalat's bond prices, which had already been under pressure for months, but here is what the market did not yet know. And this is the detail that reframes everything. The $4.9 billion forgery was not the only fiction. As investigators began pulling at the structure, they found that the total gap between Parmalat's reported financial position and its actual financial position was not $4.9 billion. It was not even close to that. According to findings by the Italian bankruptcy administrator, Enrico Bondi, the total hole in Parmalat's accounts, the aggregate of fictitious assets, hidden liabilities, and misappropriated funds. The Bank of America letter was simply the document that broke the surface. Beneath it was a fraud of a scale that Europe had not seen before. Investors who had purchased Parmalat bonds, many of them. Italian retail investors who had been sold the securities by their banks as conservative investment-grade instruments, were now holding paper that was worth, in practical terms, almost nothing. The bonds had been rated investment grade as recently as the summer of 2003. The rating agencies had relied on the same published accounts that contained the fabricated figures. The entire chain of institutional verification had failed at every link. On the 18th of December 2003, Parmalat SpA filed for extraordinary administration under Italian insolvency law, the equivalent, in practical effect, of bankruptcy protection. It was the largest corporate insolvency in European history at that time. 14 billion euros, roughly 135,000 creditors, 36,000 employees across 30 countries whose jobs and pensions were now tied to a restructuring process of staggering complexity. The speed of the final collapse was striking even by the standards of large corporate failures. From the moment the Bank of America confirmation was received to the date of the insolvency filing, fewer than 3 weeks had passed. Bond prices had fallen by more than 80% in that window. The Milan Stock Exchange suspended trading in Parmalat shares. Italian banks that had extended credit to the group began disclosing their exposure. The numbers were large enough to rattle the Italian financial system. Callisto Tanzi was arrested on the 27th of December 2003, 9 days after the insolvency filing. He was 65 years old. Italian prosecutors charged him with market manipulation, false corporate communications. He was held in custody in Milan. What the investigation then began to uncover was not just the mechanics of the accounting fraud, but the question of where the money had actually gone. Because a fraud of 14 billion euros does not simply evaporate. Some of it represents losses that were concealed rather than stolen. Genuine operational failures in Brazil Argentina, and elsewhere that were papered over rather than disclosed. But a significant portion, according to findings by bankruptcy administrator Enrico Bondi and Italian prosecutors, had been misappropriated. Approximately 500 million euros, according to Bondi's findings, had been transferred from Parmalat Group companies to entities controlled by or connected to the Tanzi family. Some of this money had gone to Parmalat, the family's travel and tourism business, which had no operational connection to the dairy group but had been sustained, according to prosecutors, by funds drawn from Parmalat's corporate treasury. Tanzi himself, in statements to prosecutors, acknowledged that transfers had been made, though the precise characterization of those transfers remained a matter of legal dispute. But here is the detail that investigators found most revealing about the systemic nature of the fraud. For years, Parmalat had been issuing bonds in international capital markets, including in the United States, while its senior executives knew, according to the SEC civil complaint, that the financial statements underpinning those bond offerings were materially false. The SEC's complaint, filed in December 2003 against Parmalat and subsequently against Tanzi and other individuals, alleged that the company had raised hundreds of millions of dollars from US investors on the basis of fraudulent disclosures. This brought the case firmly within American jurisdiction, and it meant that the legal consequences would extend well beyond the Italian criminal courts. The restructuring process that followed was one of the most complex in European corporate history. Enrico Bondi, appointed as extraordinary administrator, pursued litigation against the banks that had structured and sold Parmalat's bonds, arguing that some institutions had known, or should have known, that the company's financial position was misrepresented. Several major banks ultimately reached settlement agreements with the Parmalat estate. Citigroup settled for approximately $149 million in 2009 without admitting liability. Other institutions reached separate agreements. The total recovered through litigation and asset sales allowed a restructured Parmalat to emerge from insolvency and relist on the Milan stock exchange in 2005. A recovery that was, by any measure, remarkable given the scale of what had been destroyed. The legal proceedings that followed the Parmalat collapse ran for years across multiple jurisdictions. In Italy, Callisto Tanzi was convicted of market manipulation and criminal association by an Italian court in 2010 and sentenced to 18 years in prison. Subsequent proceedings and appeals modified elements of the sentence. Fausto Tonna, Parmalat's former chief financial officer, pleaded guilty to criminal charges in Italian proceedings and received a reduced sentence in exchange for cooperation with prosecutors. Several other senior executives were convicted in related proceedings. In the United States, the SEC obtained a consent judgment against Parmalat SPA in 2004, under which the company, in its restructured form, agreed to certain undertakings without admitting or denying the allegations. The SEC also filed civil complaints against Tanzi and other individuals. The American proceedings ran in parallel with the Italian criminal cases and reflected the extent to which Parmalat had accessed US capital markets through its fraudulent bond offerings. The auditors did not escape scrutiny. Grant Thornton International and its Italian member firm faced civil litigation in connection with the Parmalat audit. The Italian firm reached Deloitte's Italian practice also faced claims. The auditing profession in Italy and in Europe more broadly faced pointed questions about the effectiveness of audit procedures for large multinational groups with complex offshore structures. For the retail investors, the Italian savers who had been sold Parmalat bonds as safe, conservative instruments, the outcome was painful. Many recovered only a fraction of their original investment through the restructuring process. Some recovered more than might have been expected given the scale of the fraud, because the restructuring was unusual, but the experience of those investors. Ordinary people who had trusted the ratings, trusted the banks, trusted the published accounts, remained the human cost at the center of the story. Parmalat itself survived. The restructured company was acquired by the French dairy group Lactalis in 2011 for approximately 3.4 billion euros, giving it a new owner and a new chapter entirely separate from the Tanzi era. The brand continued. The milk cartons continued. The factories in Colecchio continue to operate. The lesson that the Parmalat case established, plainly in the record, is this. Audit confirmation procedures that rely on documents provided by the company being audited rather than obtained directly and independently from third parties are not confirmation at all. The Bank of America letter was accepted for years without direct verification. When direct verification was finally sought, the fraud collapsed in weeks. The control that should have caught the forgery on day one was the same control that eventually ended it. It just took a decade too long.